Hi, it's Amanda here from Wealth Planning Partners, and we thought we'd run a series of videos on property with what's going on in markets at the moment due to coronavirus. You're probably as sick of that word as I am, but I would love to introduce today Alex Minter from the Astute Property Network. Alex, can you tell us a little bit about your group, who you are, and what you do?
G'day, Amanda. Thanks for having us. Look, we're a property organisation who works alongside mortgage brokers, financial planners, accountants, and businesses within the financial services industry. And they typically engage us with their clients to give education in the space of property. Anything from, how do we find an investment that is going to do what we need it to do for us, down to we've set up a self-managed super fund. How do we find a property that's going to be right for the fund? So we're able to help identify with the clients potential growth rates they may require, potential yields they require, essentially reverse engineer it for them, which then guides us in the directions of locations and assets that meet their criteria.
So, similar to a buyer's agent, that would be
Yes,
a good description.
we do have a buyer's advocacy arm as well. So we do have, I guess it's more of a boutique service where if somebody has a specific asset in a specific location, we're engaged to go and look for those properties for them as well.
Excellent. So, one of the questions I've been getting at the moment from people is about the market cycles. We know markets move in cycles. The bum's fallen out of the stock market at the moment. But, in the olden days, it would be that means good things for property. And then the GFC meant maybe it wasn't. So, there's a bit of confusion. Can I ask where you think we are in the cycle at the moment, and how do you know for sure?
Absolutely. So that's a question that we've been fielding quite a lot over the last 3 to 4 weeks, and pretty much most organisations or groups who do what we do have been fielding similar. So what we've actually done is, look, we have reached out to researchers, research houses, and we have compiled data around similar events. And I guess without nobody has that crystal ball to know what is going to happen, especially given this unprecedented time. So I think what a lot of people are doing is going back and looking at historic data around these similar events to kind of help us understand what to expect going forward from here.
So,
So what
I'm
I'll do, Amanda,
guessing
I'll
the
just share.
GFC would be the most similar recent event in memory
Yeah,
that
I
we
think
could compare
the,
to.
the event that all of us have pretty much been through are the most similar. There are events prior to that as well, but the most recent, probably the most fresh, is the GFC.
Yep.
So I'll just share a
I'll
screen
just
with
say
you.
for international people listening, you may not call it the GFC, which the Australians called the global financial crisis. I believe in America was the global recession. So,
Yep,
whatever happened in your world around 2008, 2010, that's the period we're talking about.
that's correct. The exact period there. So where are we here? So if I just go to beg your pardon, I'm just going to stop that share. I'll just go to a different screen for you. Screen two. So if we look at similar events for you, this slide here, this one has been circulating. This was put together by CoreLogic, and for those who aren't familiar with CoreLogic, look, they're a reputable research house. They provide data to valuers, property organisations, research organisations. It's a very reputable source. They've released this recently, which once again highlights similar events. But what's very clear from this graph here, it's the grey areas there are the time frame that these similar events have happened. And we recorded events there, or the recorded events there, such as obviously the GFC, which is what we just touched on, the early 90s recession, the dot-com bubble, the dot-com crash, and a few other things. But what's very clear after these global events that do have an impact on our economies is the Australian property market does spike after every event, right? So normally, the property market, especially for Australians, has always been our safety net. And if we just go back to similar events, we've always gone there when the dust settles. So that's very clear after these economic downturns and economic events that there has been those property spikes.
So, look, 2020 looks like there's been a bit of a spike coming up already, but we've obviously got to put that into perspective now with what we've had happen. So yeah, what's next?
Well, once again, if we just drill further into those or two events that we are all familiar with, and this is the early '90s recession, which was from 1991 to 1993, and it's very clear there that the differences is that the cash rate was at 10%, right? So very different to what it is today.
Absolutely.
However, the unemployment rate is very similar to what we expect it to be today. So hovering around that 10% mark. So similar circumstances there. However, money was a lot more expensive back in the early '90s. But given that 3-year period, over the 3 years ending in 1993, 8 out of 8 capital cities produced positive price growth. Okay, and that was between 2%, which was in Melbourne, up to 27% in Perth, or not up to, but in 27% in Perth, which is a capital city. What was clear from these, this downturn as well, this recession, was regional towns, they remained buoyant or they performed well as well. So it's not just capital cities that always do well with these circumstances.
And this wasn't tied to the mining boom back in the early 90s either, was it? That was more early the noughties than 90s.
That's correct, yes. The mining boom was obviously in the noise, absolutely right. But what we'll look at as well is we'll just drill further into the GFC, which is 2008 through to 2010. Similar experience. However, the difference is here, the unemployment rate was lower than what we are seeing today or what we're expected to see today. But the cash rate was still quite high, right? So it was still up, around 7.5%, 8%. Now, given that time, property prices recorded again, 8 out of 8 capital cities, positive growth over that 3-year period. So, and we've just highlighted a few points down there, or a few key cities, which was Darwin, which achieved 32%, which is massive, and Melbourne 21%. And again, regional towns did okay as well. So it wasn't just the capital cities.
So that's to point out, during these financial crises, property still did well during that time, didn't have to wait until that was over for it to bounce.
Exactly right. So we do see a downturn, or we do see a flat period. And for those who lived in Sydney, Sydney stagnant for 7 years and then skyrocketed, over a very small period of time, over 3-year period, it hit double, triple figures almost. So it does, that's how it's historically performed.
Okay, so I suppose there's some people now sort of wondering, should I stay or should I go? Probably actually more related to your next slide. What sort of things should they be considering?
Well, look, should I stay, should I go? I guess you're maybe referring to should I sell or should I hold on to the asset? Once again, it's a question that we have been fielding as well recently, or recent times. And we understand, when things like this happen, jobs are lost, incomes are reduced. We understand that some people may be in dire situations, and at the end of the day, you've always got to do what's right by yourself and your family. And if you've got to sell, you've got to sell. However, if you're just sitting on the fence in regards to, well, look, I don't need to sell, my funds are okay. If I have to, I can hold the asset. At the end of the day, it's going to be up to the individual. But if we just go back and look at historic data again, and we'll take, the GFC, 2009, again for an example, because we spoke about the cash rate back then. The cash rate back then, was hovering around that 7.5% mark. So the average interest rate on a home loan or an investment loan was at 7.5% in 2009. So after the GFC, or throughout that GFC period, that was a big pinch on a lot of people's back pocket. And we'll actually see a true cash flow in a second of how much it actually cost to hold a property back then.
Okay.
But the difference today is the cash rate it's as low as what it has been historically, so 0.25%. So the average interest rate at the moment is in the 2s and 3s, which is extremely different compared to 2009 when that GFC period was happening. So there are, once again, going back to when people are sitting on the fence going, well, I can hold the asset, but should I sell? At the end of the day, it always depends on what their strategy is. But we'll just have a look at another indicator or graph here. we've got the values of three capital cities in 2009, which is Sydney, which was 490,000. That was the average price point. Melbourne recorded 400,000, and Brisbane recorded 442,000.
So that was right in the guts of the GFC, basically. Yeah, the markets had tanked, things were bad.
Exactly right.
Yep.
Now, there was only two reasons people sold back then. One was, the cash rate being so high and interest rates being so high for your home loan, you may have needed to sell, right? So they had to sell.
So you couldn't afford to hold. Yep.
They couldn't afford to hold, exactly right. The other reason was it was panic selling. So there was a lot of talk in the media, which it always happens. The media love the doom and gloom stories. There was a few faces of the media who are still on TV and radio today who will remain nameless, saying, sell your properties, you've got to get out now. So the people who did that lost, especially in Sydney and Melbourne. Because if you look at the value of Sydney and Melbourne, especially in 2019, Sydney's median house price was $973,000, which was an increase of 98.7%.
That's a lot of growth to miss.
A lot of growth to miss. Melbourne recorded $778, so that was a growth of 94%. And Brisbane recorded $546, which is a growth of 23%.
Look, still not shabby, is it? So
no, not shabby. And the reason Brisbane or Southeast Queensland didn't perform as well as what the other capital cities did was, it does go back to fundamentals, but without going into those fundamentals, Brisbane had a very strong run up until 2008. Okay. An extremely strong run. Then it sat flat. Sydney did the same. It sat flat for quite a period of time, and then skyrocketed over a 3-year period. But over an average period of 10 years, it doubled. Yeah, so the people who at the moment, or to answer your question in regards to should I sell, it always comes down to your own circumstances. But if you're just sitting on the fence at the moment, I would look further into the actual fundamentals here, and look a bit further into what's predicted to happen after the dust settles during this. So I suppose
it begs the question, really, what are the holding costs now that people need to consider?
Very good question. So what we actually put together is, this is a true cash flow of what it costs to hold an asset, a property, specifically in 2009. And we've just taken Sydney as an example, which was the average price, a median price of $490,000. And we've just done an interest-only loan as well. So what's very clear here is we've got the purchase price of $490. We're using a 4.5% yield, right, which is $424 a week. We're using that 7.5% interest rate, which is what the average interest rate was to hold the asset back then. And we're using a single income of $80,000. Okay, so we're not breaking records there in income. Now, after all expenses are paid, after all of your incomings have come in, it still costs $22,100 to hold an asset in 2009.
That's a lot of money out of an $80,000 taxable income.
Absolutely, yeah. Which, broken down is circa $425 a week, right? Now, if there was a depreciation component, after the tax came back in, it reduced it to $10,500 a year, which was still circa $200 a week. So that's back in the post or during GFC times. It was a significant hit to somebody's back pocket.
Yep. And what's that look like today?
So if we look at today, the exact same circumstance, so we're using the exact same purchase price.
If you can find a $490,000 property in Sydney.
Right?
Apples and apples.
Yep. We're just talking about cash flow.
Absolutely.
We're using the exact same yield, of 4.5%. However, we have reduced the interest rate to 3%, which is an average interest rate of an interest-only loan today. And we're still using the same income of $80,000 a year. Now, what's very clear here is the property is actually positively geared by close to $1,000 a year, which is very different to back in 2009.
That's massive, isn't it?
To hold an asset today, as you can see, based on pure cash flow or pure cash figures, it's worlds different, worlds apart. Which is once again why we're not expecting a massive dip or crash in property pricing in Australia, and that really goes down to the amount of cushioning that these banks are providing at the moment, and the actual cost to hold assets is more affordable than what it's ever been.
Cool. So, just playing devil's advocate here, if we've got mum and dad have both lost their job, tenants lost their job, what sort of things can people do to be able to try and, save that property?
Good question as well. So, look, I think the media has been pretty boisterous in regards to the options that you have out there at the moment. Look, I suggest if you are in dire straits and it's really uncharted waters for you, have a chat with your bank. Obviously, they're giving these six-month grace periods at the moment. Just get really clear on what that means for you with these 6-month grace periods. Have a chat to your mortgage broker or your financial advisor as well. They can probably point you in the direction of organisations that may be able to help you here. If you've got tenants who have lost their jobs, try and negotiate something with them. So there's so much cushioning, in the economy at the moment that's out there. It's there to protect owners, it's there to protect renters, it's there to help everybody. But look, there's plenty of options. At the end of the day, I would suggest, first of all, just understanding what your actual cash flow is, what your circumstances are, and then, probably your first point of call is speaking to your bank.
Excellent. Okay, thanks for those tips, Alex. Appreciate your time. And people can get in touch with you via the Astute Property Network website, I'm guessing, if they'd like to have a chat about their cash flow or options.
Absolutely. So, look, we reach out to us. We source property nationally. We can have a look at your current situation, see what you currently have, what you're trying to do, and point you in the direction there.
Excellent. Thanks so much for your time, Alex.
No problem.